Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Today I have Jack Crooks with me, and Jack's going to be talking about global trading, impact on currency markets, identifying opportunities using FX options. You know that Jack is the founder of Black Swan Capital. He's the resident expert on currency flows. He watches the currency markets very, very closely each and every day. So he has his eye on just about every currency pair or the most commonly traded ones in the world. And not only does he trade options, he trades futures, he trades the spot market, he writes a newsletter each and every day, the free Currency Currents, and he also has a paid service. We'll talk about that a little bit more in the end of the presentation. But Jack, I want to thank you for joining us here at the ISE. Really appreciate it.
Thanks for having me, Steve.
Pleasure's always mine. Let me give you the controls, and we're good to go. All right, Jack, you should be able to do share desktop at the yep, excellent. Okay, it's working.
Okay.
See the green, so we don't see the slides yet, but yep, perfect, Jack. Thanks again. Really appreciate it.
Okay, great. Let's get going then. Thank you, Steve, and thanks to ISE again for sponsoring these events. ISE does a wonderful job of offering a lot of great free education. And so I urge you to definitely check out the ISE products, especially the currency options product, needless to say. It's a great product. They have several listed options. And even if you have any questions, I don't know any other exchange where you can just tap into somebody like Steve for questions you have regarding trading on the exchange. Anything you have, he's always been available to us for our clients. So he's just a wonderful resource. So let me get started. Today, hopefully the title of this isn't too confusing, but what I really meant today about the trading impact really was the trading as it relates to exports and imports and those types of things, and this idea that the U.S. dollar has to depreciate in value in order to drive U.S. exports, which I think is a giant fallacy and a big canard, and in fact very, very damaging to the U.S. economy, and in fact damaging to the dollar because of the fact that if you have this mentality, then it means you have an implicit weak dollar policy, and it goes hand in hand. And ultimately, as I said, I think it ends up driving capital away from a nation, a weak dollar policy, and I'll get into some of the reasons of that. Just want to show you again some of the charts so you can take a look for yourself at this really just basic fallacies. The chart speaks for themselves. This is our disclaimer on the option side. And there's a disclaimer from the Black Swan side, so you've been doubly disclaimed. I'll let Steve come back and talk to this more on the ISE options and why he thinks they're just a great product to trade. So I'll save that chart for him. Starting out with this idea of the U.S. current account deficit. This is a quarterly measure of the U.S. current account, and if you've been involved in the foreign exchange markets much at all, you've probably heard this ongoing, which I say is a giant canard, a giant fallacy, that the weak current account deficit means the U.S. dollar is going down. It leads to that. One leads to another. And I happen to think that a weak dollar actually leads this process. It's not the current account that's leading the dollar down, so to speak. But the reality is, in any time frame that you and I really trade in, whether short or even a long-term time frame, the current account deficit really isn't something you can trade off of as it relates to the dollar over time. But you've noticed that the currency analysts, or I should say the currency newsletter writers primarily, who love this idea of the current account deficit going down, therefore the dollar has to go down, haven't talked about the current account deficit too much, you may have noticed, because of the fact that the current account deficit in the U.S. has improved about 50% over the last several months, in a very short time period, from, as you can see on this chart, from $200 billion per quarter, which is about $800 billion per year, which was over 6%, approaching 7% of U.S. GDP. We've now improved, and now the current account is about a little less than $100 billion per quarter. That's a massive improvement in the current account, and this really goes to the whole idea of global rebalancing and the fact that U.S. consumers are not buying as much from overseas and are saving more. And as I said, it's very important in terms of money flow and longer-term capital flow and how it impacts the U.S. economy, but it's not something that you can really trade the dollar on. And let me just show you. This is the U.S. dollar imposed on top of the same current account deficit. Now, I was only able to go back to 1985 with this because of the U.S. dollar index on this particular program that I had. That was all the series went back to. But again, just want to make the point here. If you look at the purple line here, that's the U.S. dollar index, and you can see there's not a great deal of correlation there in terms of the U.S. dollar index up until around 2002, 2003 time frame, and we see there that the U.S. dollar started to accelerate downward along with the move in the current account deficit. And as I go through some of the other charts of our major trading partners, you also notice that 2002, 2003 time frame is kind of a blast-off point, and I think it's a time frame in which the structure of the U.S. economy in terms of its funding of all of the globe changed. You may remember the year 2000, kind of the date in which we saw the end of the NASDAQ bubble pop in the U.S., and then the major concern at that point was that we were going to have a global deflation. Alan Greenspan got busy along with the rest of the central banks and lowered interest rates tremendously and continued to pump more and more money into the economy then. The European Central Bank had rates very, very low also, historic lows at the time, and the Bank of Japan already had a zero interest rate policy at the time. So you had the three largest central banks in the world pumping money out very, very quickly then to stave off so-called global deflation. You may also remember this is a time when there was a lot of concern with all the Chinese workers coming onto the market and all the Chinese final goods prices coming onto the market. India, too, there was that concern that continued deflation flowing out of Asia as those final good prices were down, going lower and lower and lower. That was kind of the backdrop or the reasoning for the central banks to push rates so low. But what it ended up doing in the process is creating free money for the investment banks in New York to start creating these massive amount of derivative products. And I think that's why you see that acceleration downward in both the U.S. dollar at that point in time and the current account deficit, where you see that correlation is tight there, really for the first time. And so I do think there was a structural change in the way the global economy was looked at in terms of just massive amount of dollar-based credit going out in the world from that point onward.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.